Debt. You hear that word, and for most of us, it just sounds stressful, right? But what if I told you that for the world's wealthiest people, it's one of the most powerful tools they have for building a fortune? Today, we're opening up the playbook the rich use to make debt work for them, not against them. All right, so let's just get right to it with a big question. Is taking on debt always a bad move? I mean, the common wisdom, what we're always told, is yes, avoid it at all costs. But the reality, well, it's a lot more nuanced. And understanding that difference is what separates the people who get trapped by debt from those who get rich with it. So where's the line? It really comes down to this idea of good debt versus bad debt. Think about it like this. Good debt, like a mortgage, helps you buy an asset, a house, that hopefully grows in value over time. Bad debt, well, that's like putting a fancy dinner on a credit card with 22% interest. You're paying a fortune for something that's already gone, and it's actively making you poorer. So what's the secret sauce that makes good debt work? It's a concept called financial leverage. In simple terms, it's using other people's money, like a bank's, to control a much bigger asset than you could afford on your own. Now here's the key. This move amplifies everything. The potential profits can be huge, but so can the potential losses.
Okay, let's walk through a super simple example to see how this plays out in the real world. Let's say you buy a house for $500,000. You put down $100,000 of your own cash, and the bank loans you the other $400,000. The market does well, and the value of your house goes up by 10%, or $50,000. You decide to sell, you pay the bank back its $400,000, and you walk away with a cool $50,000 profit.
But wait, here's where the magic really happens. That $50,000 profit, that wasn't a 10% return for you. You only put in $100,000 of your own money. So you actually made a 50% return on your investment. And that is the mind-blowing power of leverage. You use the bank's money to make 5 times the profit you would have with just your own. Okay, so how do we take this big idea and bring it back down to earth, back to your wallet? It really just boils down to asking one simple question for any loan. In the long run, is this debt going to make me richer or poorer? Basically, good debt is anything you borrow that's an investment in your future self. A mortgage, as we saw, helps you build equity. Student loans, and this is a big if, therefore a degree with a solid return on investment can supercharge your lifetime earnings. And of course, a business loan gives you the capital you need to create something that actually generates income. Bad debt? Well, it's the total opposite. It's when you borrow money for stuff that's just going down in value. We're talking about high-interest credit cards for things you want but don't need, or car loans, financing something that literally loses a chunk of its value the second you drive it away. And then there are payday loans, which are just a brutal trap designed to keep you in debt forever. All right, now let's zoom out from our own finances and look at the big leagues, the corporate world. You'd think a company with billions and billions of dollars in the bank would never need to borrow money, right? Well, you'd be wrong. In fact, they are some of the biggest borrowers on the entire planet. I mean, just look at this. Apple is sitting on over $170 billion in cash, but they still have over $100 billion in debt. Microsoft, Alphabet, it's the same deal. So what gives? Why on earth would they borrow money when they could just pay for anything they want from their own massive bank accounts? It seems totally backwards, but it's actually a brilliant financial move. Okay, here's the secret. It all comes down to something called the cost of capital. See, for a giant company, not all money is created equal. Using their own cash, which is called equity, is actually expensive because their shareholders expect a really high return on it. But borrowing money, debt, is often way cheaper. Plus, the interest they pay is tax deductible. So for them, borrowing is just the cheaper, smarter way to fuel their growth. But, and this is a huge but, leverage is a double-edged sword. When it goes right, it feels like magic. But when it goes wrong, it's an absolute catastrophe. Remember the 2008 financial crisis? That was fueled by banks being leveraged up to 44-1. It meant even a tiny dip in the market could, and did, wipe them out. More recently, a firm called Archegos Capital vaporized $20 billion in just 2 days because their leveraged bets blew up. This is not a toy. It's a tool that demands absolute respect. Okay, so now we're going to get into the really wild stuff. The apex predator of leverage strategies, a method that allows the ultra-wealthy to basically live off their fortunes without ever paying taxes on their gains. It has a pretty provocative name: buy, borrow, die. So how does this actually work? It's a 3-step dance. Step 1. Buy assets that go up in value. Stocks, real estate, art. And the key is you never, ever sell them. Step 2.
To get cash for your lifestyle, you just borrow against those valuable assets. A loan isn't considered income, so no taxes. Step 3. Die. When you pass away, your heirs inherit those assets at whatever their market value is on that day. It's called a stepped-up basis, and it legally erases all the taxable gains that piled up during your entire life. Poof, gone.
Now, before you get any ideas, you have to know this strategy is not risk-free, not by a long shot. If the market tanks and your assets drop in value, the bank can hit you with a margin call, which means they demand you pay back the loan right now. That could force you to sell your assets at the worst possible time. And, of course, there's always the political risk that the government could change the tax laws and close this loophole.
So, after all that, the good, the bad, the billionaire playbook, where does that leave you? Well, it brings us to this huge philosophical showdown in the world of personal finance, a battle between two giants, Dave Ramsey and Robert Kiyosaki. In one corner, you've got Dave Ramsey. His whole philosophy is that debt is a dangerous risk that needs to be completely eliminated. His system is all about safety, discipline, and it's aimed at the everyday person who might get into trouble with credit cards and overspending. In the other corner, you have Robert Kiyosaki. He argues that good debt is a powerful, essential tool. His strategy is for disciplined investors who know how to use leverage to buy assets that put more money in their pocket. For Ramsey, it's simple, almost biblical. The borrower is slave to the lender. He sees debt as a heavy chain that holds you back, robs you of your freedom, and just creates stress. His entire goal is to help you break those chains. And then you've got Kiyosaki, who flips that idea completely on its head. He says good debt is essential for getting rich. He doesn't see it as a chain at all. He sees it as a lever, a tool that, if you use it the right way, can launch you toward wealth way faster than just saving your money ever could.
So, who's right? Is it Ramsey or Kiyosaki? You know, the truth is, neither one is really wrong. Debt isn't some moral failing. It's just a tool. The real question is about the person holding the tool. For someone who struggles with financial discipline, Ramsey's advice is a lifesaver. For a savvy, educated investor, Kiyosaki's path offers incredible speed. It really is like fire. It can cook your food and keep you warm, or it can burn your entire house down. So in the end, it really comes back to you, your knowledge, your discipline, your comfort with taking a risk. And I'll just leave you with this question to think about. Now that you know the rules of the game, is debt a trap that you should avoid at all costs? Or is it an opportunity just waiting to be seized?